Hey guys, welcome back to the channel, and today I thought I'd bring to you a technical video, and we're going to be covering the power of 2 4-hour momentum filter. So what is momentum for us? The way that we see momentum is essentially what you would consider trend, and our higher time frame is the 4-hour. You could use this on the weekly, on the daily, 4-hour, potentially even a 1-hour, whichever is the higher time frame for you. The most important thing is use the time frame that sets your overall bias. Are you overall short or are you overall long? Obviously, if you're scalping the market, you probably won't need to consider that at all. However, if you're more of a swing trader or a day trader, then you want to be looking at overall trend and momentum and following that curve, right? So the higher time frame momentum will almost always overpower any lower time frame direction in the long run. You can take counter momentum or counter trend moves, right? But those that are experienced enough in trading a few years in, you'll know that those counter plays tend to be short-lived. You would either need to, if trading counter trend, counter momentum, have a very set and much smaller risk to reward tool and set your TP at certain key areas and turning points where you believe price could continue, versus if you're trading along with trend and momentum, you don't necessarily need to set a TP that's 1 to 3, 1 to 5, 1 to 10. You could actually push further if you really wanted to and look at overall structure. And like most people would do in that situation, is take partials along the way. Being on the right side of momentum more often than not, what that's going to do is, yes, it's going to create less opportunities, but the flip side on the positive is that it's going to instill patience. It's going to instill more discipline. It's going to give you more free time. And the trades, the setups, the opportunities that are left on the table are going to be of a higher probability nature. You have a far greater chance in the market staying on the right side of momentum, similar to a gravitational force. If you imagine the currency is being pulled almost by magnets into that certain direction, do you want to be fighting that gravitational pull? Or if price is just dropping, it's like the old saying goes, don't try and catch a falling knife. And that tends to be those that are trading counter momentum. So how do we determine a correct shift in, for us, higher time frame momentum? Well, the way that we specifically look at it, we do have set rules and mechanics around that. So if you're looking at this chart in front of me, and we'll go over some live chart examples shortly, you can see that price was very clearly printing higher highs and higher lows, right? And we're using, if you can imagine this as the 4-hour time frame, and these swing points are more defined swings. They're not fractal highs and lows, they're swing points. And there's going to be some discretion from one trader to the next in determining what is a swing high and what is a swing low. Sometimes it'll be much more obvious and sometimes less obvious. But what we found over the 4 or 5 months of using this in the community is that actually, if someone is waiting for a later swing break than someone else, it doesn't make too much of a difference actually overall. But we can see if we get one break of a structural low followed by a second break, that's when we have confirmation of a shift. And it has to be 2 rather than 1. It can either be 2 lower lows for a shift from bullish to bearish, or 2 higher highs from a bearish market shifting bullish. How to determine whether it's simply a liquidity grab and for price to continue, which does happen in a trending market. Well, you can see again, the same chart is producing consistent higher highs and higher lows, and there'll be more than one opportunity where price on that time frame takes liquidity. But if we look at this one example where the orange line is the swing low, it takes that. One, there's very little momentum and follow through in that move. And 2, it's the only singular move that actually breaks. That second structural low does not get taken. It simply reverses and continues to take on that structural high. So that is how you can determine what is and what isn't a momentum shift. Now, those that trade the power of 2 who haven't already implemented the 4-hour filter, I recommend to go and do some testing on that, and you'll know what I mean with directional bias. Those that are new to the system, new to the strategy, we basically have 3 directional bias. We have follow through, which is momentum continuation. We have NFT, which is no follow through, which is essentially our reversal. And we have strong follow through, SFT, which is basically like follow through, but not needing to wait for price to pull back into discount for buying or pull back into premium for selling. We can continue that strong momentum and go check back on some previous technical videos, maybe choose one of my backtesting videos, and you'll see those examples in play. So how can we use momentum with bias to filter out the lower probability trades over our larger sample size and continue focusing on the medium to higher probability chances of the market playing out in your favor? Just like I've shown in those examples there, if you are fighting overall higher time frame momentum, you will take some winners, but you will take a lot of losing trades as well. If you can reduce 3 to 4 losing trades a month, each month, just over one pair, what's that going to do to your psychology? How is it going to improve your psychology? How is it going to improve your chances of passing funded challenges and verifications? And of course, it's going to give you more free time. It's going to instill more patience and discipline to wait for these setups. So we have a traffic light system where we have low probability, medium probability, and high probability scenarios based on the 4 hour alone. That's before we even look at the 15-minute and consider or contemplate any entries. So for green, it would be very high probability. So pro momentum, let's say momentum is to the upside, the 4 hour is trending up. We want to see directional bias follow that direction. So we want follow through to the upside and a pull back into discount to buy, or we'd want no follow through to the downside as an indication as a reversal to again buy, following that momentum. We know that over a large enough sample size, these trades hold a higher strike rate. Also, if you're not trading the power of 2, but you're looking at momentum, overall structural swing points and overall trend, and you're targeting more than a 1 to 3, you are able to do that because that then will exceed a structural high. If the market is trending upwards and you are well priced on your entry model, whether you're trading off the 1 minute, the 5 minute, or the 15 minute, whatever, if you are targeting the 4 hour structural high and or beyond, then you have a greater chance of that following through and happening than if you're counter momentum. So amber for us is our medium probability. It's almost like a conflict. So you'll have pro momentum but counter directional bias, or you'd be pro directional bias but counter momentum. For us, and me personally, as a coach right now, because I'm trying to focus on those better quality probability setups and to also make sure that I'm not spending too much time at the charts, I'm trading literally one pair on one account, one pair on another, and will only trade the high probability following momentum and directional bias, and also the medium probability, but only that follow momentum. So I will not take a medium probability power of 2 trade based on the 4 hour momentum filter if it is pro directional bias, however, counter momentum. And I'm happy to leave winning trades on the table, knowing that I'm going to leave also a lot more losers on the table too. And then the red is our low probability. Now, it doesn't mean that it holds a terrible strike rate or that you're not ever going to see winners, because you will. And we have traders that trade the power of 2 system based on directional bias alone on one pair to keep their risk exposure low, but will trade all scenarios. And they end each month, almost every single month, in profit. So this would be counter momentum and counter directional bias. So it is classed as a low probability scenario, not setup, but for our overall trade idea scenario. However, you will find winners in there. It's just whether you personally are going to be able to put up with the increase in drawdown. Would you be happy taking 4 losers in a row versus 2 losers in a row in any given month before you get a winner? And if the answer is yes, then you take them. If the answer is no, filter it. That's why we called it the 4 hour filter, all right? Because it's filtering out those lower probability trades, especially for those who decide to, out of personal choice, trade 2, 3 or more pairs, because you're increasing your risk exposure by doing so. I'll just pause the video there and give you a little bit more information about who I am. If you didn't know already, my name's Scott Taylor. I'm a co-founder of Evolution Markets FX, where we help create traders following a mechanical rule-based system, trading off the higher time frame, helping our traders go from 0 to funded within a period of 6 to 12 months. We teach with a full broken down video course library that you can see here. Every element of the strategy is broken down, including fundamentals, technicals, psychologicals, and more. We also have a Discord community where like-minded traders and a professional group help each other out, and it's where you can ask the coaches questions, you can celebrate your wins, and everybody grows together. Just like our successful traders like these who have gained funding recently, and those that are achieving regular payouts like these. So if you're interested in learning our mechanical trading edge and becoming consistent, profitable, and funded, look at the description below and there'll be some links to join the mentorship. Anyway, back to the video. So let's run through the charts and go over Euro USD and actually have a look at some examples. Keeping it super simple here, we've got Euro US dollar on the 4 hour. I'm going to stay on the 4 hour, and we're zoomed out enough so we can see what the market has been doing. We can see these trends. We can see that price has been pushing up, and we can also see that price then, and we can't see beyond that yet, has then been pushing lower. Of course, on a higher time frame than the 4 hour, this would be considered one move up, right? But if we're focusing on the 4 hour, which is enough for day trading, for swing trading, gives enough opportunity, it doesn't move too fast, it holds a lot of weight and power, we can basically dissect the 4 hour in terms of its momentum and shifts based on these mechanical rules, and identify then for our lower time frame execution entry, whether that be 15-minute, 5-minute or lower, and then factor in what our high probability overall directional bias for the day would be. Now, an easy way of doing this is by literally using 4 hour ranges. So if we just start around here, because we can see that we've come from this very bullish leg. I'll zoom in a bit more. So we've got the low of the 4 hour swing range, what I would consider the swing range, and the high here. We have a pullback inside of here, and I'm going to use that as a range. And we just move it across until we see a break, right? What we can also do is use any kind of arrows or shapes just to outline where your highs and lows are. So I'm going to use a black dot. We've got a low, we've got the highest point, we break the high again, and we trail back to the lowest point before that break of structure. That swing structure, right? So now we've got a starting base. And at that point, if you didn't see any of this to the right, you would anticipate that price is either just going to continue higher from there, or will pull back slightly before continuing higher. Why? Because momentum is to the upside. That has been the overall trend for approximately 42 days or so. Now, what happens is we take the low. Now, remember, we need 2 lower lows in order to see a shift from bullish to bearish, and 2 higher highs for a momentum shift to confirm from bearish to bullish. Now, we only get the one. Initially, we get that wick, which we don't really consider anyway. But once we get that real follow through, we can see, okay, we've had a lower low now. And the best thing to do is to change color. Just use anything. Just pick green for now. And we've now got a new dealing range. Swing dealing range, sorry. We're not using fractals for those that trade power of 2. You're wondering why there's no fractals on here, because fractals can confuse what is a swing point. And again, there's no real right or wrong. There might be individuals that will have a certain high or lower swing point, whereas someone else doesn't, want to be a bit more conservative and wait for something a bit more obvious. And there's nothing wrong with that. So once we break that low with this push, we can see we've now had our second lower low. And we can trail back to the highest point and mark that was our swing high. Moving our range. So just really a wick, I wouldn't consider this. Then we break that again, and you can see we're continuing now bearish nature. Highest point here, and at that point it would be here. We'll extend all the way down to this lowest point. I'll extend this down as well. I'd play each candle in a live scenario until it starts to pull back. None of these are a swing low point. You can see that's the turning point. And we'll trail back to the highest point here. So we've had our first, which could have been a liquidity grab to continue higher, but it wasn't because it broke again. We've now had a confirmed momentum shift bearish, and we're having continuations to the downside. So what is our anticipation is that price is going to continue lower, knowing that at some point and at any point, we are going to anticipate and believe that this time frame, this 4 hour time frame, is going to want to come and take some liquidity before continuing that trend at some point. We don't know when. And we can see that that happens here. It takes that swing high. First of all, it only closes with a wick, which is a nice sign of a lack of momentum to the upside. The second sign is it just rejects straight away. So that rejection candle doesn't absolutely solidify anything 100% because nothing in Forex does from a technical standpoint, but it's a nice indication, again, if you only had these two candles at that point and nothing else afterwards, that you can continue looking for sells based on whatever your lower time frame entry is. Now, as soon as we break this low, we continue this down until we have that defined low, and we trail it back to the high. But this one, we'll just change the color again because it did print a new high, but only one of them, right? So we've not shifted back bullish again. It's a liquidity run. So if we keep going now, this is our high, this is our low. It breaks again over here. That becomes our low. We trail back to the highest point, which is this one, and that becomes our swing high. We get the same thing happen again, look. This is our swing high, our swing range low. We're looking at sells, ideally in a premium of this, so sells in here, sells in here, sells in here, and as it's pushing back up here, we probably won't get many sells in this because it's quite momentous, quite impulsive run into this. But what do we get? We get that same thing that we anticipated, that liquidity run. We mark it a different color because it is a new high. And of course, we don't know that if price does that and creates a second one, we're now likely shifting bullish, but we don't get that. What happens instead is it breaks lower. So we continue with our bearish nature. Let's continue a bit further. Once that breaks, the highest point is here. We trail that down to the most defined point. So that's our confirmed high. That's our confirmed low. It breaks again. Highest point, lowest point. I would trail down to this one personally. New low, which gives us a new high. Then we get a new low again here. Now something interesting happens here. So new low, new high, and what happens here? It takes the high. Now here is a nice example of where some will say this is a swing low, swing high, whereas others will see that as simply one move up and down. And I would, because it's literally only two candles, it's not very significant. We don't have a set rule, or I don't have a set rule of how many candles it must be, but the way I see the market, if you're looking at these swing points, they're much more defined, whereas this is just really more of a 15-minute swing. So I would see that basically as one move up, right? There's one push up. Nonetheless, it does takes two highs actually, but it doesn't mean it's bullish because we've only had one higher high. Again, for that to shift, we would need this and then it to break that high. That's the important key factor here. But what does it do? It breaks the low. So it continues down here. Even I would extend down to here, to be honest, myself. New swing low. That breaks. Highest point, lowest point. New swing high, new swing low. And this is a great way of backtesting as well, because once you've got these swing points, you can see, okay, I've been trending since here to the downside. So far, we've had 2 months of bearish momentum, bearish trend off the 4 hour, knowing that if I'm only going to sell either in premium of my 4 hour swing range or directly after I've got confirmation of a 4 hour liquidity grab and then whatever your lower time frame entry model is, you know you're going to have a higher strike rate and you're going to see better risk to reward, whether it's a 3-to-1 fixed every time, set and forget, park that money, or whether you're going to target these 4 hour structural points. Neither is right or wrong. It's whichever strategy works for you, right? So we get a new high, a new low here. Highest point from here down to here. I personally wouldn't use this bit in here. I know a few did recently. This was only September, back end of September this year. But myself, I use this one down here. Still bearish at this point, and I'm going to keep going until we do actually get a shift to the upside. And this is exactly how I saw EU over the past 3-4 months, by the way. So still bearish, producing lower lows and lower swing highs. Now after this range, we've had, for the third time, is it the third time? 1, 2, 3, fourth time, a run of the highs, and we can see what happened next. But of course, at this stage, you wouldn't know. Look how bearish that looks. So you trade what you see, not what you think, is another saying that is absolutely stuck by me. But having that mechanical rules allows you to carry on selling when you believe you're still bearish. And once you get the rules aligned where you've shifted, at that point and that point only is when you shift your bias and become bullish. So I was still bearish at this point until that high gets broken. So we've now, for the first time, had 2 high highs. So we've gone from a over 60 day long bearish market with multiple liquidity grabs, but only singular pushes, to not get you caught out on the wrong side of the market thinking price is going to head higher, and just keep targeting the lows and keep selling from a premium price. Now we've had a liquidity grab, a fail to close below that structural low down here, and we've closed above this first swing structure. So now we are bullish, and now you can start to look at buys. So we'd have the lowest point to the highest, larger 4-hour swing ranges. There's our low, breaks again, lowest point to highest point, and we'll very soon catch up to current price where we're at 22nd of November right now, producing high highs, higher lows, which is why buys in a discounted area now are higher probability. Yeah, we can see an exhaustion of liquidity there, exhaustion of price, taking liquidity, sorry, and the lowest point to the highest would be here. New higher low, new higher high. And the final range, which is where we are at right now, is, I would consider this one. So a new higher low because it broke the high. And we're here right now. So we're literally bullish right now. So if I were to be looking at sells, I would know that mathematically they would be holding less weight. Now, of course, price could easily just drop out like this, right? Even if it did that, we'd be taking one low, knowing that this could easily just continue, because we've not had that scenario yet. We've only just recently shifted bullish around 30 days ago, and we've not yet had a 4-hour run on liquidity of a structural swing low like we had 2 to 3 times here at the highs. Now, the market isn't perfect. It's not going to imitate every single month or quarter. Price will move uniquely, and we look at every scenario slightly uniquely. However, the anticipation that price will move in that way, like it has done for years and years and just hasn't changed, we want to follow that momentum, follow that flow, follow that trend, knowing that once we reach a discounted price, or liquidate the lows by one and see that exhaustion, see that reaction to this low, that we want to continue buying. So we can either look for buys based on our fractal directional bias here, or we simply wait for a structural liquidity sweep here and wait for our bias to shift on the lower time frame for execution and follow that bullish range. So now you should have a real good understanding of how I look at the markets in terms of 4-hour swing points and how I'd identify where it becomes a shift in momentum and trend versus what's simply a liquidity grab. How I can identify trends and how I can identify and filter my scenarios based on a low, medium, and high probability scenario, even if that means I'm sat on my hands for 2 weeks on euro dollar before I take a single position. Less is more, and something I say often is you either win slow or lose fast. If you overexpose yourself with too many trade ideas, pro trend, counter trend, 17 pairs, you know you're going to see larger drawdown periods. I would rather take less trades, higher probability, be more patient, have more time for other things, and make sure I finish each quarter in a nice profit. Anyway, thanks guys for watching, and make sure you're subscribed if you're not already. Every subscriber helps the channel grow, and the more it grows, the more effort and consistency I'll put into creating new, valuable, free content for you all. And if you've not already seen and you want to see more content, click on one of these two videos here, and I'll catch you on the next one. See you later.